Hello and good morning. You're watching BQ Prime. We're all back from a long weekend here from those of us in Bombay, and earnings seasons continues. Over the last weekend, we had a bunch of companies report their financial earnings, and now we're joined by Mr. Ramesh Iyer from Mahindra and Mahindra Financial Services. He's a vice president at Mahindra and Mahindra Financial Services, and we'll be doing a check-in with them about their sort of quarter performance and how they've registered a strong growth in their overall disbursements and in their assets under management. Good morning, Mr. Iyer. Thank you so much for joining us.
Morning.
Right.
Thank you.
Right. So just to get us started, we saw sharp growth in the assets under management for Mahindra and Mahindra Financial Services over on a year-on-year basis. Could you tell us a little bit about what is driving this growth on an incremental basis? Where is most of the demand coming from?
So, we do a lot of work in semi-urban rural market, and we have seen a very positive sentiment in the rural market. The buoyancy continues. The footfall at dealerships are good. And therefore, overall, across the geography, across the product, we have seen growth. But to be more specific, I think pre-owned vehicle have shown phenomenal growth. Heavy commercial vehicle, the bus segment has shown a good growth. And we have also gaining market share in most of the product lines that we are in. Put all this together is the reason for our AUM growth between previous year to this year.
Right. And you said used vehicles have been pretty hot, as a pretty hot segment. Would you say these are used commercial vehicles, light commercial vehicles? Could you give us a little more color on that?
I think we are not in the used heavy commercial vehicle, but clearly we see a lot of demand on the passenger vehicle side. We have seen a lot of demand on the pre-owned tractor side. We have seen a lot of demand on the LCV side. So I think each of this segment is doing very well. We are not there in the heavy commercial vehicle big time.
Right. Okay. Understood. Now, coming to the second segment here, which is the collection efficiencies Mahindra and Mahindra has been able to achieve over the last quarter. Collection efficiencies have really improved over the last financial year as well. Could you tell us a little bit more about how this was achieved, especially given some of the back and forth and the corrective actions seen against Mahindra and Mahindra Financial Services by the RBI earlier in the year? How have you fine-tuned your collection strategy to sort of move in this direction?
So, after the second wave of COVID, every quarter we have seen improvement in the market. Again, it's a reflection of good cash flow in the rural market, customers' ability to earn, and then therefore they repay. We work with the earn and pay segment, and that's very clearly reflected in their earning potential. The monsoons have been pretty good, therefore the farm cash flows have held up, infrastructure is doing well, and therefore we see a lot of improvement on the collections from the assets which are put for infra use. And overall, therefore, the collection efficiencies have been good, resulting into maintaining high asset quality or improvement in the asset quality.
Right.
In as our strategy on recoveries are concerned, yes, we were slow on repossessions post November, but that has helped us really to reach out to customer, negotiate with them, and settle with some of these delinquent customer, and that's also a reason why you see declining trend in the stage 3.
Right. And at a strategic level, have you also made some fine-tuning adjustments to how you work with third-party collection agencies here?
No, so we were never using third party for collection of our
For
installments.
recoveries, right?
Definitely, we were using third party for repossession of assets because that's a very specialized activity, and there are people who are specialized in this. We have definitely tightened the process in terms of selection of such agents, verifying their credentials, asking them to follow certain very clear rules and regulations, and it's all HO controlled and driven. And those are the improvements to the process and controls that we have made to the repossession agent, using them for repossession of vehicles.
Okay, understood. Now, I also want to come to the write-offs that Mahindra and the Financial Services did over the past quarter. There were about 600 crores worth of write-offs. Could you give us additional color on what these write-offs were? Do you expect this to happen over the next couple of quarters as well, some write-offs happening? What's your overall outlook on that?
So it's a part of the overall program. And, when you do in retail assets, you will have situations where you repossession, sell, and therefore there are losses which you write off.
Sure.
There are some asset accounts which you'll have to write off. But you must look at an overall credit cost, and it is on just about 1.2%.
Yeah.
So it's all part of the whole thing. And therefore, it's nothing new. And historically, if you look at these numbers, would be very similar. And we don't see any alarm around that. And even going forward, we think the trend of this nature would continue. There could be some improvement because the pre-owned vehicle resale prices have improved.
Okay.
To that extent, the process could be slightly lower.
Okay, understood. I want to come to the tractor vehicle segment for a second here because it is also a good indicator of the economic performance we see in the rural economy. Now, concerns about inflation have somewhat faded given that we're seeing growth in rural wages as well, but weather continues to be one of those concerns. How are you plotting your sort of expectations or trajectory for tractor financing over the next couple of quarters with weather being an overhang?
So clearly, the volume of the tractor business that we do will, of course, depend on the OEM sales volume.
Sure.
And we can't be really influencing a big change. And that's why I referred to the pre-owned tractor segment,
Right.
where there are many customers who may not want to probably invest in a new tractor, but will look at second-hand tractor as a great opportunity. And it's a great plus for us. But in as far as overall recovery is concerned, again, one should understand 40% of the tractor cash flow comes from non-farm application. That is the haulage application where they attach trailers and all those kind of stuff. And we see a lot of buoyancy in that front. So
Okay.
we don't see any major concerns arising from that. And even from a monsoon perspective, I think the announcement so far that we have seen or reports we have seen so far are pretty close to average plus.
Yeah.
So therefore, I don't think it's a major concern. One has to wait and see how widespread they are and are they in relevant state. So and once that happens, we will not really have any pressure arising out of that as well.
Okay, understood. Now, I want to come to the liability segment here for a second. I was reading a recent report from India Ratings, that is Fitch's India Ratings, and they indicated that some NBFCs going forward may have some challenges finding funds because banks are also hitting their internal limits on how much they can lend to NBFCs. How are you planning your liabilities trajectory for FY24? Are banks going to be a big part of it? Do you see yourself leaning towards market-linked instruments to raise funds as well?
So, we raise funds from all instruments that's
Right.
possible for an NBFC, and we have always stated that we will be very prudent in allocating limits within what we can do. We have a fixed deposit accepting license. We borrow from banks. We borrow issue debentures. We have bonds. We have also do securitization of our portfolio, and many of our portfolio qualify for priority sector, and therefore there is an attraction for our assets. We have not ever had a liquidity pressure, and we are also holding close to about 3 months of buffer in terms of our liquidity is concerned. And we have a AAA rating and a track record for last 25 years with a Mahindra brand name. I don't think we see any pressure on our borrowing front, but definitely one has to be very sure and clear that you borrow from all possible instruments and have a good ALM match, which is what we have always practiced.
Okay, understood. I was reading through the investor presentation, and I don't know if this has been referenced in the past or not, but there was an interesting change that caught my attention. In the vision statement, there was a sentence that said the target has gone from being the financial service provider for semi-urban and rural India to emerging India. Could you explain the difference to me and how does Mahindra see it?
So clearly, what we were doing was we were focusing on just semi-urban rural India and providing largely vehicle and tractor loans. We were not into other things. So the changes that we have taken is, one is we want to be a solution provider in the sense that not necessarily just provide loans for vehicles, tractors, etc. But if somebody wants loan for something else, but if we are not able to provide, can we even arrange for them? We also want to significantly play a role on the liability side by offering them investment products like fixed deposits. We have our own mutual fund and we want to distribute, including insurance distribution. So I think that's a solution part of it. In as far as emerging India is concerned, I think we have similar customers across the country and not necessarily just in semi-urban rural market. So there are several customers even in the urban market who kind of prototype similar to what we work with in the semi-urban rural market. And we want to work with all of those customers who are looking for either a credit or a solution for their credit requirement. And that's a broad basing of our vision.
Okay, understood. Now, just to wrap up here, because we're running close on time, could you give us any forward-looking guidance on what you're expecting credit growth to look like over FY24 for Mahindra and Mahindra Financial Services? And also, if you could guide us on, your net interest margins were around 7.5, 7.6%, and you would want to target the same sort of net interest margins till 2025. How do you expect to maintain that given the rate change environment that we're living in? Those two things, could you tell us a little more about?
So for us, NIMs are concerned, I think our belief is in a quarter, 2 quarters from now, you may even start seeing declining interest rates. And as you've seen that we have already protected our margin by even passing on some kind of a increase in borrowing cost. So therefore, maintaining NIMs is very visible, and therefore we will play around the same range that we are in. So for us, the growth is concerned, again, I said it sometime before, that our growth is related to the OEM growth. And the next 3 years for semi-urban rural market is expected to be pretty good given what's happening on the infra front, given what's happening on the farm front. And therefore, maintaining growth, even the AUM, should not be a challenge. And then getting into various other pieces like the SME, loan against property, personal loan segment, etc., should add to an overall growth story. And therefore, we are very positive on our growth going from here.
Right. Any specific number you're targeting over FY24?
Normally not, but as I said, the trend is growing trend, so one can actually project from there.
Okay, understood. Thank you so much for making the time to speak with us. It was really great having you on and learning from you about Mahindra Financial Services quarter gone by. And we hope to have you soon join us again.
Thank you so much. Thank you for having me.
Thank you. And thank you to everyone for watching.